there. But the SBI chairman, Dinesh Kumar Khara, is speaking, addressing the press on the numbers. Listen in.
The bank remains very well capitalized, and we have sufficient headroom to take care of the normal business growth requirement. Our capital adequacy ratio has improved by 85 basis points on a YOY basis and stands at 14.68%. CET1 ratio has also improved by 33 basis points and is now at 10.27%. And both the ratios are well above the regulatory requirements. Digital continues to be an important customer acquisition engine for the bank across assets as well as liability products. During the year, we have sourced 64% of the savings bank accounts and 35% of the retail asset accounts digitally through YONO. We have embarked upon a journey of creating digital bank of choice within the bank as we have moved on to YONO 2.0 for further improvement in our offerings. Our subsidiaries have also consistently performed well and continue to create significant value for all the stakeholders and most importantly for the customers. Most of our subsidiaries are the leaders in their respective segment. We will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. Before I conclude, I would like to thank you all for your continuous support to the bank. We consider it as a privilege to be able to contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable returns over the long term. I wish everyone here the very best of health and happiness. Floor is now open for your questions. Thank you.
Thank you so much, sir. Now we move to the media Q&A. I urge the media to raise their hands and unmute themselves when called upon. We request you to follow the format and restrict yourself to 2 questions each related to the results. First up, we have Ritu Singh from CNBC-TV18. Ritu, please go ahead.
Could you help me unmute? Could you unmute?
Hear you, Ritu.
Please unmute. Unmute. Mr. Khara, if you can hear me. Sir, the asset quality, of course, has seen a significant improvement year on year. What we wanted to understand is, in terms of provisioning, what is the thinking? For your NPA provisions, you've almost halved them in the quarter. But with the expected credit loss provisioning expected to kick in the next couple of years, what have you factored in terms of what you would require? Is there an internal assessment? And have you started to make any provisions for that? One. Secondly, also, sir, in terms of your slippages, from 25,000 crores in FY22, now it's down to about 18,400 for the year. Could you guys guide us as to what you're seeing in the coming year as well? The fresh slippages have come down significantly. Is that trend going to continue to play out? And as far as demand for credit is concerned, yes, it's been in double digits for the year. Interest rates have also peaked. Now they're expected to come down. What's your sense? What's in the pipeline? Where is the demand coming from? Are corporates utilizing their credit lines? If you could give us some guidance there as well.
I think one question itself is quite a heavy questions. Multiple questions in one question. You have taken the full advantage of the clause one question. Anyhow, I'll start with the first one, which you have in your mind is something which is very heavy on your mind, is relating to expected credit loss. Well, of course, first and foremost, this is just a concept paper which has been introduced by RBI, and they have not yet formed up their views. And even if they have very clearly indicated in that concept paper also, even if it gets introduced, it will be spread over a period of 5 years. Now, let me share with you. When it comes to the ECL, it essentially means that the provision would be made based upon the expected credit loss. And expected credit loss is a probability of, one is a loss given default, LGD, and also the probability of default. So which is nothing but a reflection of the underwriting standards. and also at the same time, how the book has been. Herein, I would like to draw your attention to the fact that our corporate book is provided to the extent of 98%. And when it comes to our retail component, which is almost as high as about 42, pure play retail is about 42%. There our NPA, gross NPA ratio is somewhere in the range of 0.6. So one, I would like to say that the loss given default as it is low. And even the probability of default, which is nothing but a reflection of the underwriting, what we have seen for last couple of years is a very clear reflection of our underwriting standards which we are adhering to. So in that kind of a situation, I would like to mention that our non-NPA provisions as on date stands at about 35,500 crore plus. So as far as our readiness is concerned, we will simply wait for the RBI guidance in this matter. And once the guidance comes in, we are very well equipped to deal with the scenario. And at some stage, we have done some calculation, but those numbers are much lower as compared to what additional provisions we are already holding in our balance sheet. So first and foremost, ECL as of now is a fiction. And if at all it becomes a reality, we are very well equipped to deal without having any impact on our balance sheet. We have always followed the principle to insulate the balance sheet fully, and our balance sheet is completely insulated from any future potential events also. Now, your second question, which I can recall, was essentially relating to the growth numbers, whether it is credit growth guidance. And also, your one question was relating to whether the kind of slippages which we are seeing, how will it look like going forward? I think, to my mind, the best of the answer for this question would be to look at our SMA-1 and SMA-2 book, because this is nothing but a reflection of the likely stress which could be there in the book. So if you look at our SMA-1 and SMA-2 book, we have seen very clearly that there is a definite reduction in the SMA-1 and SMA-2 book over the period of time as compared to March 22, where it was 3,544 crores, SMA-1 and SMA-2. It peaked out somewhere around 8,000 odd crore in September 22, but again it has come down to 3,200 odd crores. We are in a position to have a very effective follow-up mechanism, and we are in a position to ensure that we recover all these stress accounts. So I think, to my mind, the quality should be what we are seeing today. We should be in a position to sustain. The third question was essentially relating to the growth. I think we are witnessing decent growth both in corporate and retail, and also even in SME as well as in agri. So I think, to my mind, the kind of activity which we see on the ground, which very clearly means that we should be in a position to address the economy's growth requirement. And I would like to also add that the macro aspect is something which will be a very, very critical component. And the kind of focus which is there in the economy for the economic activity, this will certainly offer us opportunity to grow as far as our loan book is concerned.
Thank you, Mr. Khara.
Please go ahead.
All right, that's the SBI chairman talking about, the expected credit loss.
He didn't say anything.
He didn't say very much.
He
said
said
it's the actual default plus expected default based on underwriting standards. But, I mean, he didn't give an exact number or assessment or anything of that sort.
But he did, Prashant, he did mention, the extent of provisioning. He kind of pretty much went out there and said 98% of corporate book provided for, 48% of the retail book is provided for. So he sounded very optimistic, saying once we have the fine print, the actual regulations, because right now this is still a discussion paper. Once it's in writing, we'll kind of cross the bridge at that point in time, perhaps.
All right, well, SBI is still down about 2% or so. 574 is where we are at. The market is not